one more session in this amazing series, and it gives me immense pleasure to welcome you all on the day 4 of Gyan Yagna Workshop Series 2 on TDS TCS for CS students. I, Ishika Anchalya, on behalf of the entire organizing committee, extend a warm welcome to each one of you to get another impactful session designed to sharpen our understanding of taxation and compliance. Today, we focus on an essential yet often complex area, TDS on non-resident payments and DTAA interplay, a subject that requires not only theoretical knowledge but also an practical insight. As future chartered accountants, mastering this will give us a strong edge in navigating a global taxation challenges. As per our previous sessions, led the groundwork covering applications, updates, procedures, and technology integration. But today, we transition into a more strategic discussion. How do compliance rules apply across borders? What risks do defaults pose in non-resident taxation? How can the double taxation avoidance agreement can be leveraged efficiently? These questions will no more be unanswered at the end of today's session. If we listen attentively, ask the right questions, and keep an open mind, this series has the potential to transform how we approach taxation. So let's keep our minds engaged, our curiosity high, and make the most of this opportunity. Before we begin, I'd like to invite our team to play the ICAI motto song, setting the perfect tone for the today's session.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तदब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you, team, for the ICI motto song. Now I would request CA Ketan Sayya sir to kindly enlighten us with his invaluable words.
No, no, I'll request Jitendra Bhai to do that first.
Thank you so much, Ketan sir. And thanks, Ishika, for that wonderful setting of the tone at the very beginning. So, energetic chairman of the WRC, CA Ketan Sayya sir. Today's speaker, CA Siddharth Parekh Chief, who is a very good friend of mine, and he accepted our invitation on a very shorter notice as well. The two volunteers of Vikasa. So this time we have Wings of Vikasa as the theme for volunteers, and the two wings are here in the form of Miss Ishika Achalya and Miss Kushi Thakur. Madhur Bhartiya, the Vikasa committee member, is also there. And along with that, I see the presence of Fenil sir, the treasurer of WRC, who is here. In absentia, the office bearers of WRC and all my dear friends. Thank you so much, students, for joining in large numbers on this particular day, which is a day 4 of TDS TCS series. And we have with us worthy speaker in the form of Siddharth. Today, as Ishika has rightly stated, that we have to learn and we have to actually understand TDS. The topic is very vital. And this particular session, which is on the payments to NRIs, that is non-residents, is very important. And I think I should not talk much because Ishika has already spoken and set the tone. But I'll just speak about the future events of Vikasa. So friends, we are planning a 4-day series on RERA, which is happening next week, starting from Tuesday, that is 20th of May. And it will be ongoing for 4 days in succession. And beyond that, friends, we have on 31st of May, Capital Markets full day seminar, wherein the most versatile speakers from the industry are coming. So I'll request everyone to please join for the this particular program, which is a physical one at the BKC of that is ICI Bhavan at BKC. Friends, also we have a plethora of events planned in terms of workshop series, which will be virtual, as well as the physical NTS, that is National Talent Search, happening on 8th of June at the BKC once again, that is ICI Bhavan. I think there are many things that are lined up. We'll be releasing them very soon, and I request you all to please be there with the efforts of Vikasa. Encourage us by joining, and also very happy learning to you all. With these, I hand over to Ishika once again.
Thank you so much, Jitendra sir. Now I would like to request Ketan Saya sir to kindly enlighten us with his valuable words.
Thank you so much, Ishika, and thank you, Khushi. I think Jitendra Bhai said everybody, but Yojan also I see. So Yojan, thank you for joining, and Madhur had left in between, but I think he's joining probably. And each one of you are doing a wonderful job, the entire Vikasa team and all you volunteers. So first of all, a big thank you to you for sparing your valuable time, showing an interest into the Vikasa's activity. And we were just prior to the event, this event getting started, we were talking that how many people will join, and I very happy to see that 70 have joined. And of course, my personal wish is that soon we should reach 150 as our number minimum. And I think this series way Vikasa team is working hard, and we are continuing with Gyan Yagna up till 9. I think we have already announced 6, 7, 8, 9. I think all are announced. So I am sure by the time we reach to peak, we will easily have few hundred people joining online. And subject, as rightly told by Jitendra Bhai, it's very interesting subject, and we have worthy speaker in the form of Siddharth Bhai, who's got huge experience. And I think very important today we see each family. Maybe few years back, NRI practice was like कि कौन कर रहा है कैसे कर रहा है, but today if we see each individual, even a small time practitioner, is having some or other NRI client. Being reason being that the travel has increased. People are traveling for business, education, and they stay longer over there. And a lot of time, they become a non-resident. And then, whatever payments we are doing nowadays, even NRI gift is covered in TDS. So, payments and then your 15 CA So, I think, this subject has gained tremendous importance over a period of few years, and we see the normal transactions are happening between the resident Indian and non-resident Indian. So very important subject to be learned by the student, because they in the practice are actual executor. You are the people who will be actually there on the forefront. Me, Siddharth Bhai or Jitendra Bhai, we are just reviewing, but actual work you all are doing. So I think it is need of an hour to learn the NRI taxation in detail. So once again, compliment to Vikasa team for thinking through and designing this entire Gyan Ganga series by Gyan Yagna series by Jitendra Bhai. Jitendra Bhai, congratulations to you for a wonderful designing of this entire series. Thank you so much. Over to you, Ishika, again.
Thank you so much, sir. Now I would like to call upon Khushi to introduce our dynamic speaker for today's session.
Thank you, Ishika. So, good evening, everyone. It is my pleasure to introduce to you all our esteemed speaker for today's session, CA Siddharth Parekh. Mr. Parekh is a partner at Sunil Ji Parekh and Company Chartered Accountants and specializing in international tax and transfer pricing advisory. With an extensive experience, including his tenure at EY's international tax team across London and Mumbai, he brings down deep expertise in cross-border taxation. He is a highly accomplished professional, and he has also scored AIR 21 in his CA final examinations. He further pursued advanced studies in international taxation and thus solidifying his expertise in global tax frameworks. Also, beyond his professional accomplishments, he has contributed in technical articles to leading international tax journals, and he actively engages in thought leadership through the International Tax Committee of the Chamber of Tax Consultants. Today, he will be delivering an insightful session on TDS, on non-resident payments, and DTAA Interplay. This discussion will explore the practical challenges and tax implications of withholding tax payments and their impact on cross-border transactions. So, let us warmly welcome CS Siddharth Parekh, sir.
Thank you, Khushi. Thank you, Ketan Saya sir. Thank you, Jitendra Saglani sir, and all the office bearers of WRC for giving me this opportunity. Let me just share my screen. Is my screen visible?
Yes, sir.
Yes.
Perfect. So the topic for today is payments to non-residents and interplay with DTAA. As we all know, this is indeed a very important topic. And as Ketan Sayya sir rightly said that no longer are the days that international tax practice is the remit or is the forte of only bigger firms or the big fours. Increasingly, we see mid-size and smaller firms, including boutique firms who specialize in international tax, transfer pricing, and FEMI advisory. And payments to non-residents, I would say, is one of the most basic or the initial step of the international tax practice. I still recollect my early days when I joined EY as a freshly qualified chartered accountant. And my first exposure to the international tax world, in fact, was preparation and issuance of Form 15 CB. So I'm very glad that I've got an opportunity to discuss today on this topic, which is very close to my heart and is sort of a fundamental as far as the international tax practice is concerned. Now, when we talk about payments to non-residents, the critical section which we are talking about under the Income Tax Act is Section 195. As we all know that under the income tax law, all sorts of business-related payments, whether they are made to residents or to non-residents, they are covered under the provisions of TDS, i.e. we need to withhold the taxes at the time of making the payments. As far as non-residents are concerned, the relevant section is Section 195. But how do we arrive at here? So the journey which we need to travel or the journey which we need to cover is captured in the screen in front of you. We start with essentially Section 6, so determination of the residential status. So essentially we check that the recipient of the income, whether that person is a resident or a non-resident, which will come from Section 6. Then we look at the charging provisions and the scope of total income, which is Sections 4 and 5. Then we need to traverse to Section 9, which talks about income which accrues and arises in the case of non-residents. So this is the journey which we need to cover as far as the domestic tax law is concerned. Having done this, what we do is based on the residential status of the recipient of the income, we will need to check. So for example, let us say we are making payments for technical services which we have received from a person who is based out of United States. Then we will check whether or not India has a tax treaty in place with United States. So we need to check whether or not there is a DTAA in place. And if there is, then we need to check whether the DTAA applies. If yes, whether there are any beneficial provisions in respect of the DTAA. Because Section 9090A of the Act clearly provides that the provisions of the Act or the DTAA, whichever are beneficial, they apply in determining the tax implications for the non-resident person. Having done this, we finally arrive at the correct withholding tax rate, which should be applied to that payment. And following that, we can then go ahead and apply Section 195. There are certain reporting, issues in terms of a chartered accountant certificate in Form 15 CB. There are instances where a Form 15 CB is not required, but we need to file a Form 15 CA, and we'll take a look at this in fair amount of detail. So as I said, the first thing which we need to look at whenever we come across any payment is to identify the nature of the payment. Correct, because what is the rate of tax which we can apply, or what is the rate of tax at which the TDS needs to be deducted essentially depends on the nature of the payment. For this, one needs to really look at section 9(1). So section 9 essentially talks about income which is deemed to accrue or arise to non-residents. Section 9(1) in particular covers income which accrues or arises by way of any business connection, so essentially business income. In respect of any property which is situated in India, so that could be either capital gains or income from immovable property, or any source which is located in India. Section 9(1)(2) covers salary income. So this is a case where salary is paid by an Indian company. So you could be a non-resident, but if an Indian company is making payment of salary, then the non-resident is brought within the charge to tax. Section 9(1)(4) deals with dividend, 9(1)(5) deals with interest, 9(1)(6) deals with royalty, and 9(1)(7) deals with fees for technical services. Remember, always the starting point will always be the domestic tax law. Whenever you are looking at any particular payment, please examine what is the nature of the payment. Having examined the nature of the payment, please go and check what are the conditions which are there under our domestic tax law, which bring that particular payment or income to tax in the hands of the non-resident. As I mentioned briefly, when we are talking about fees for technical services, usually the source of the payment is if the person who is making the payment is resident in India. So for example, if let's say you have an Indian company and the Indian company is making payment of fees for technical services to a non-resident, then section 9 says that the fees for technical services is chargeable to tax in the hands of the non-resident. So the source which is there under our domestic tax law is the residence of the person who is making payment of the income. We find similar source for salaries as well as dividends. However, as far as capital gains or income from immovable property is concerned, it talks about the property or the asset being located in India. So always be mindful about the different conditions which are present in section 9 of the Income Tax Act. What you also see is the corresponding provisions which you will find under the model convention of the DTAA. So to give you a background or give you an idea, double taxation avoidance agreements, there are two models. When I say models, what does it mean? It means that whenever a country wants to enter into a tax treaty with another country, there are certain you could say draft treaties which have been put into place. And there are two models which are widely available. One is the OECD model, which is published by OECD. And the second is the UN model, which is published by the UN. Now, these models, essentially what they do is they provide for distribution of the taxing rights between the country of residence as well as the country of source. So for example, if you would open a treaty and you would look at Article 10 equivalent of the treaty, which deals with dividends, typically what you would see is you would say that the country of source can tax the dividends, but only up to 10%, 15%, or a 20%. It would impose a threshold. When you would look at Articles 11 or Articles 12, you would find similar provisions which would say that interest income may be charged in the country of source, but not exceeding 10% or not exceeding 15%. So essentially what they do is they impose a restriction, or they impose a limitation on the domestic tax law of the source country by saying that you may tax a particular income, but only up to a certain extent. In certain scenarios, they may not provide any limitation, and in certain scenarios, they may also provide for exclusive taxation only in the country of residence. The next question which comes to our mind is why TDS? And I was doing some research for the purpose of our today's session, and I was surprised to know that almost 46% of the gross collection of direct taxes for financial year 23-24 came by way of TDS. So essentially, it is a mechanism with the revenue authorities, with the income tax department, and with the government is using in order to collect the taxes in advance. Second and more important fact is it also creates a trail. It ensures there is accurate and timely reporting of the various transactions, and it avoids essentially, any kind of tax evasion can be tackled easily. Of course, it is a burden on the person who are making the payment, but it is required in our national interest. Now we will come to section 195. And this is the scheme of section 195, which is the governing provision as far as TDS payments to non-residents is concerned. So we have 195.1, which we will look at it in fairly fair amount of detail, which talks about the scope and the conditions for applicability of this particular provision. 195.2 and 195.3, they deal with applications for a lower or a nil withholding tax certificate. So these are scenarios where, for example, let us say if we are dealing with payment for fees for technical services, we know that under the Domestic Act, the TDS rate is 20% plus surcharge plus cess. However, there is a provision wherein you can apply for a lower withholding tax if you indeed believe that the tax ultimately, if the tax is withheld at a higher rate, it would lead to a refund at the time of filing the return. So section 194(5)(2) and 3 deal with the scenarios, and we will look at it. 195.4 is a procedural section dealing with validity of certificates. 195.5 simply talks about rules which have been put in place both for 195.2 and 195.3. 195.6 is a very important provision and which we will be dealing with in lot of detail because essentially 195.6 talks about Form 15CA Form 15CA CB, which is of practical relevance and important to all of us. 195.7 talks about certain relaxations, and 195A is grossing up of tax, which we will deal with. With this, now let us take a look at the provisions of section 195. So section 195.1 says any person responsible for paying to a non-resident, and it covers both whether it's a company or other than a company, whether it is any interest or any other sum chargeable under the provisions of the Act, shall at the time of credit of such income to the account of the payee or at the time of payment therefore in cash or by issue of a check or a draft or by any other mode, whichever is earlier, deduct income tax thereon at the rates in force. The first thing which strikes us is there is no basic threshold which is mentioned in section 195. This is in contrast to the provisions which we see for the TDS payments as far as domestic payments are concerned. So, for example, if we are talking about 194C, you have the thresholds of 30,000 or 1 lakh. 194J, you have the thresholds of now increased to 50,000. However, as far as section 195 is concerned, which deals with payments to a non-resident, there is no basic threshold, which means that even if, let us say, you are making payment, very small payment or a small remittance of only $100, you would still need to comply with the provisions of this Act. Let us look at the threadbare analysis of section 195.1. Who is the payer? If we see section 195.1, it starts with any person responsible for making payment to a non-resident. The term any person includes both residents as well as non-residents. So, this is again a very common misconception or a common, one would say, a common mistake, which sometimes one tends to make by assuming that the provisions of Section 195 only apply if you are a resident in India. No. Even if the person is a non-resident, even if the payer is a non-resident, and he is making payment to another non-resident subject to fulfillment of the other conditions, even then section 195(1) would apply. Again, there is no relaxation for individuals or HUF, unlike the domestic tax provisions. The second aspect is who should be the pay or who should be the recipient of the income. Clearly, we are dealing with section 195, which deals with TDS for non-residents. So, uh, uh, the payee has to be a non-resident. Now, one tricky aspect here is, let us say if there is a foreign company, and let us say the foreign company is considered to be resident in India. So as you all would be aware, under Section 6, a company is considered to be tax resident in India, either if it is incorporated in India, so it's a domestic company, it's an Indian company, or its place of effective management is situated in India. What do we mean by place of effective management? It means that the critical decisions in respect of the management of the company, functioning of the company, are being taken by its directors, the board of directors, the top management, while being physically being present in India. In such cases, a foreign company is considered to be resident in India. So there has been a clarification that even such a foreign company, even though it would be considered to be an Indian resident because its place of effective management is in India, even then section 195(1) provisions would apply to any payments which have been made to such a foreign company. Another question here then would be, would pay include resident but not ordinarily residents? I'm not sure if the participants are allowed to speak, but feel free to put your answers in the chat box if your thoughts. So the question is, let us say you're making a payment to a person who is resident but not ordinarily resident. Would such a payee be covered within the provisions of section 195? That is the question.
Yeah, Siddharth bhai, I think people are putting it in Q&A section. There are answers.
Okay, so we have
Because
we have Priya who has said no. We have Jai who has said yes. RNOR is covered. We have some few more answers who are, wherein participants are saying no. I think the answer here is one needs to go back to section 230 of the Act. So section 230 of the Act defines the term non-resident. Because remember, section 195(1) clearly says that any person responsible for paying to a non-resident. The term non-resident is defined in section 230, and 230 clearly provides that a non-resident is a person who is not a resident, and for the purposes of section 92, 93, and 168 only, it also includes an RNOR. So by inference, an RNOR is not included within the definition of a non-resident as far as section 195 is concerned. So the answer is no, payments to an RNOR are not covered within the scope of section 195. Next, so we looked at who is the payer, we looked at the pay. The next point to check is which are the payments which are covered. So section 195(1) covers any interest. There is an exclusion for not interest which is covered under 194 LB. Then interest under 194 LC and interest under 194 LD. Now 194 LD, there is a concessional TDS rate of 5%. in respect of infrastructure debt fund. So this is a policy choice wherein there is a lower rate of tax. Similarly, for 194 LC, again, there is a concessional rate of 5%, which applies in respect of ECB, which has been availed before 1st July 2023. So these are specific scenarios wherein there are lower rates of tax which are already provided for in a specific section dealing with interest payments to non-residents. And given that they have been carved out or they have been excluded from the scope of section 195(1). Otherwise, all other interest payments are covered within the scope of 195(1). Moving on, in addition to interest, it also covers any other sum chargeable under the provisions of the Act, not being income chargeable under the head salaries. I'll repeat, any other sum chargeable under the provisions of the Act. So what is very clear, and it has also been held by the Supreme Court, both in Transmission Corporation as well as in GE India, that it only covers payments which are chargeable under the Act, and it would not cover payments which are not chargeable under the Act. Why is this important? Remember, when we started this discussion today, we started with understanding the nature of the payment, then looking at the residential status, the charging provisions, and then going to section 9. The reason is, first we need to determine whether or not that particular payment is chargeable under the Act, and only if such a payment is chargeable, then we are covered within the scope of section 195(1). What is important to note here is, let us say if you're making a composite payment, and even if a portion of it is chargeable, then you cannot take a stand that you will not apply the provisions of section 195(1), but you need to definitely apply 195(1) and apply the withholding. Of course, a question may arise as to whether you will apply the TDS rate on the entire payment or whether you are allowed to bifurcate. In practice, given the onerous provisions and the liability which may be slapped onto the person making the payment, usually you would not try to bifurcate between the chargeable and the non-chargeable component. However, you would make an application to the income tax officer where you are confident that the TDS should be applied only on part of the payment, or you would take a conservative stand and you would apply the TDS on the entire payment. Another question is, why is salaries being excluded from the scope of section 195? Any views here? Question is, why is salary being excluded from the scope of section 195(1)? Does that mean that if you're making payments of salary to an individual who is a non-resident, then there should not be any TDS? We see quite a few people who are active and are replying in the Q&A box. It is absolutely correct that salary payments are covered under section 192. And if you carefully read section 192, it covers salary payments both for residents as well as non-residents, unlike some of the other provisions like 194C, 194J, which only apply in the case of residents. So remember, if you're dealing with salaries, and the individual who is receiving the salary is a non-resident, still you would be covered by section 192 and not by section 195. We now come to a very important aspect, which is the time of deduction. Okay, so we have looked at who is the person making the payment. It could be a resident or a non-resident. Who should be the recipient? We looked at it, and it has to be a non-resident. We now know that the term non-resident is defined in section 230. We looked at the types of payments or the nature of payments which are covered under section 195. Now we are coming to what is the time of deduction. And section 195(1) provides that the deduction shall be made at the time of credit of such income to the account of the pay or at the time of payment, whichever is earlier. So pretty standard. We know this by now, whether it is time at the time of actual payment or at the time of credit in the books of accounts, whichever is earlier, we need to deduct the TDS. There are certain exceptions in as far as interest payments by governments or public sector bank or public financial institutions are concerned, in which case they are allowed to deduct the TDS directly at the time of payment. More likely, this deals with scenarios where the government would be accounting for such interest on cash basis. The question here is, can there be an exception to this rule in view of the fact that when we are dealing with non-residents, we also need to take into account the provisions of the DTAA. And I think here is what gets very interesting. So if you look at the provisions of the DTAA, especially if you look at articles 10, 11, and 12, or the equivalent in a real life treaty, which deals with taxations of dividend, interest, fees for technical services, or royalty, the language which you find in the DTAA usually is that the source country is allowed to levy the tax, or the source country is allowed to collect the tax up to a certain threshold, provided it is paid to a resident of the other contracting state. So let us try to rephrase this sentence. So let us say fees for technical services, which is arising in India and paid to a resident of USA. Now, the contention of the taxpayer here was that the term which is being used in all the DTAAs is paid to a resident of the other contracting state. It could be USA, France, UK, any other country from which the non-resident person is coming. And the question or the argument which was taken by the taxpayer, by the person who was making the payment, was that the DTAA only requires one to deduct the tax or apply the withholding tax on payment basis, because the term which has been used is paid. Now, this was litigated in the case of Simmons, and we have a favorable decision by the Bombay High Court, which has allowed the payment of TDS on payment basis. So essentially, till the money is actually not paid out to the recipient, the courts have held that there is no obligation or there is no requirement to deduct TDS. Again, this issue came up for examination in the case of Ampersand Cyprus Limited. And here what happened was the Mumbai tribunal actually refused to adjudicate on this issue, because it believed that the earlier decision of the Bombay High Court and some of the earlier decisions of the tribunal itself did not comprehensively address the issue, and there were conflicting views on this particular judgment. Given that the Mumbai tribunal has then referred this matter to a larger bench to examine the meaning of paid, till now the special bench has not arrived at a decision in this manner. What is also pertinent to note here is, if we look at section 43(2) of the Act, very clearly paid has been defined to mean either actually paid or incurred according to the method of accounting. Now, as you would know that most of us, when we are dealing with companies, most of the companies would be following accrual system of accounting, which mean we would obviously book the particular expense, and the pay is also usually identified, i.e. the identity of the pay is already known, in which case it would be a more prudent view to adopt that TDS under 195(1) should always be deducted at the time of accrual or payment, whichever is earlier, notwithstanding the favorable ruling which is available. Of course, we do not know how the larger bench will rule on this issue. So, in case of our clients who have taken this position, if you are assisting with defending this position, obviously you can take assistance or benefit of the Bombay High Court decision. However, if we are advising our clients, or if we are issuing a certificate under section in form 15CB, it would be we should definitely take a conservative view, given that the matter has not reached finality. Another small point to keep note of is payments need not necessarily be in terms of money, but it could be in other modes. So we had a case of Kanchanjunga Seafoods Limited, where the charter fee for fishing vessels was paid in the form of fish catch. The fish catch essentially had a value attached to it in terms of what would be the open market price of the fish catch. And given that it was held that TDS was still payable, similar decision was rendered in the case of Biocon Pharmaceuticals. Raymond Limited Mumbai Tribunal was a very interesting decision. So this was a decision wherein Raymond Limited, which is obviously a company resident in India, it had engaged a non-resident company because it was raising some funds from outside India. So it had engaged the services of a company for raising of funds outside India. And during the course of this, the non-resident company was the one which had, aggregated the funds. I do not recollect whether it was by way of issuance of bonds or otherwise, but it had aggregated the funds outside India. And what the non-resident company did is it withheld its fees. So let us say, it was entitled to a commission of 5% of the overall monies which were raised by Raymond Limited. So it deducted the 5% and it remitted the balance to Raymond Limited. Now the question before the court was, in such a scenario, technically, if you see, there is no physical payment or there is no transfer of funds which is happening from Raymond Limited to the non-resident service provider. However, even in this case, even if the non-resident directly adjusts the payment from what is due to you, even in such a case, the provisions of 195(1) would apply and you are required to comply with the provisions. So another question here to the participants is based on this, obviously we have seen that section 195(1) would apply when we are looking at payments which are flowing from a resident to a non-resident. Right. And if it is through a banking mode, obviously your banker will ask you for compliance with section 195. They will ask you to produce a form 15CB, 15CF. What about payments which are, for instance, made via credit cards or are directly made via net banking? Would provisions of section 195(1) technically also apply in such a scenario? I'll repeat the question again. Let us say if you are, for business purposes, you are subscribing to a foreign database and you choose to make the payment by your credit card. Okay. And let us say your company has a credit card which allows the employees to, incur expenses for official business purposes. In such a scenario also, would you be required to comply with the provisions of section 195(1)? That is the question. And I can see a couple of responses coming in the Q&A box, and all of you have correctly understood and are replying yes. So be mindful that uh, 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 that provisions of section 195(1) will always apply. Just because you do not have a banker who does not ask you whether or not you have complied with the provision, does not mean that provisions of section 195(1) would not apply, because section 195(1) covers payment in cash, check, draft, or by any other mode. And the term any other mode is wide enough to cover all different kinds of scenarios. So be mindful about this compliances. As we progress, we will also see there are certain penalties for non-compliance. Of course, in practice, we do not see the revenue authorities or the income tax department invoking the penal provisions in smaller cases. However, it is important to note that those penal provisions do exist, and the department can always levy a penalty if we do not comply with the provisions of section 195. Now, the second most important aspect which we need to deal with. So step one is understand the nature of payment, check whether or not it is that particular payment is chargeable to tax as per the provisions of section 9. Once you have determined that the payment is chargeable to tax, you come to section 195(1) and you determine the applicability of section 195(1). So you look at the pay, you look at the payer, you look at the pay, you look at the nature of payment, right? Now, the next important aspect is at what rate are we required to deduct the TDS? And unlike the domestic law provisions, which clearly prescribe, in 194C, you will find a particular rate. In 194J, 194I rent payments, you find a particular rate. That is not how section 195(1) works. What section 195 does is it says that the deduction shall be made at the rates in force. Okay. Now, as far as the rates in force is concerned, we need to refer to the rates which are specified by the Finance Act of the relevant year. So we need to look at the TDS rates, which we will find in part 2 of the first schedule of the Finance Act. So that is the first point. So let us say if we are dealing with dividends, for example, you would look at part 2 of the first schedule of the Finance Act, and you would see that whenever dividend payments are made to non-residents, the TDS rate under the domestic tax law is presently, in fact, from 1st April 2023, if I'm not mistaken, it is at the rate of 20%. Similarly, for fees for technical services, royalties, which are the most common payments which we come across, again, the rate is 20%. If we are dealing with long-term capital gains, remember the amendment which came through from last July of 2024. The rate of tax is 12.5%. If we are talking about short-term capital gains, listed securities, it is 20%, and so on and so forth. So depending on the nature of the payment, there are specific rates which we find in part 2 of the first schedule of the Finance Act. So our first step will be to look at these rates. And remember, these are the basic rates, and the rates under the Act need to be further increased by surcharge and cess. As far as surcharge is concerned, if you are dealing with foreign companies, the surcharge rate is 2%. If the payment exceeds 1 crore but does not exceed 10 crores, and it is a rate of 5% if it exceeds 10 crores. There are differing slab-wise surcharge rates as far as individuals are concerned. So please do not make the mistake because when we are dealing with TDS, for residents, typically it is always 194C, 1% or 2%. Commission again 2%. It for under 194J, it is 10%. So it's a flat rate. We never increase those rates by surcharge or cess when we are dealing with TDS for residents. However, when we are dealing with TDS for non-residents, always remember that the rates which are prescribed under the domestic tax law, they need to be increased by the applicable rate of surcharge as well as cess. So that is the first point. Now the second point. Having done this, we need to look at the rates which are specified in the DTAA. How do we do this? So there is a sequence of events, or there are sequence of steps which one needs to do. And what is the sequence? First, you need to look at who is the recipient of the income. Correct? You have already determined that. Let us say it is FCO, which is a foreign company, and for the sake of simplicity, let us say this foreign company is a resident of the United States. Okay. So we need to check where does this foreign company has its tax residence. Having determined this, what we need to check is whether or not India has a DTAA with this foreign country. So in majority of the cases, you will see, USA, UK, France, China, Singapore, Mauritius, yeah, India, I believe, I do not know the exact number, but I'm sure that we have over 80, 85 DTAAs in place. So you need to check whether or not there is a DTAA in place with this particular country. Now, in the recent years, there is a one very specific aspect which one needs to be careful about, and that is the impact of MLI. MLI stands for multilateral instrument. Okay. So, taking a step back, a DTAA or a tax treaty is a contractual agreement between India and the other foreign country. The role or the purpose of this contractual agreement essentially is to allocate the taxing rights between the two countries. So, whenever you have a non-resident person who is earning income from India, you do not want to levy a very high level of taxation. And the underlying reason is that non-resident person also will be suffering tax in his home country or in his residence country. And which is why, you would want to cap the amount of tax which is levied by the source country so that you can boost trade between the two countries, and that by economic growth can be supported. Right. So with this objective, there is a DTAA which is signed between the two countries. Now, if you will look up any DTAA and all the DTAAs which India has entered into, you are able to find them on the income tax website. So if you look at this DTAAs, unlike our Finance Act, which every year, there are amendments and, there could be amendments which take place, and we have a budget followed with the finance bill receives assent. A DTAA is not something which can be entered into each year. So in fact, the lifespan of a DTAA is usually anywhere between 10 to 15 years at a minimum. In fact, there could be treaties which are even older, So imagine the treaties which you are reading today have been put into place 10 years ago, 15 years ago, and in some cases more than 20, 25 years ago. Now, obviously, it may happen that over a period of time, there might be some unintended mischief or unintended consequences of the relief mechanisms which have been agreed upon in a DTAA, right? And to prevent or to plug this loophole, the treaty needs to be amended. However, as I said, it is not very easy to amend the treaty, because what happens is there are competent authorities. So competent authorities are essentially senior members of the CBDT who are representing India as far as entering into DTAA is concerned. So it is the competent authorities of the two countries who negotiate a treaty, correct? Because it is in the interest of India as well as the other country to ensure that the negotiation is fair and it is beneficial for both the countries. And after this negotiation, what happens is once the text of the treaty is finalized, it needs to be approved in accordance with the domestic law of both the countries. So, in India, typically the treaty needs to be laid before the parliament, and it gets assent before it is notified. So, and other countries would also have their internal procedures. Hence, it is not possible to simply unilaterally amend a treaty. You can only amend a treaty by way of protocol. Now, imagine if India has 80 treaties, okay, and let us say that India wants to, add an anti-abuse provision, or it wants to bring about a specific change in all of these 80 treaties. Then what it needs to do is it needs to negotiate with 80 countries, right? And then after negotiating with the 80 countries, all these 80 treaties need to then be ratified, and they need to be re-notified, right? And it's an Herculean task. Now, to overcome this, we have the concept of a multilateral instrument. And the multilateral instrument was introduced because there was this entire project called the base erosion and profit shifting. So, the base erosion and the profit shifting project was a global tax project, and India was also a part of this project. Wherein what they realized that there was a problem of treaty shopping, or there was a problem of avoidance of taxes by clever planning, which some of the foreign companies, or some of the multinationals were using to avoid payment of their fair share of taxes. So multilateral instrument was a mechanism wherein what they have done is, they have agreed to certain anti-abuse provisions, and they have agreed clause by clause what these additional provisions would be. And they have said that here is the text, and everybody who wants to agree to this particular text can sign up to the multilateral instrument. And again, India has signed up to the multilateral instrument, and so have other countries. And in instances where both India and the other foreign country has signed up to the multilateral instrument, and the choices which we have made to amend the particular treaty matches with the choices which has been made by the foreign country, in those instances the DTAA would be modified to on account of the MLI. So to cut a long story short, whenever you are reading the DTAA, please do not forget to also read the MLI which has been put into place, and whether or not that particular DTAA is a covered tax agreement, and what are the changes to the particular DTAA on account of the signing of the MLI by India as well as this particular foreign country. So coming back to our discussion here, we need to look at the rate specified in the DTAA. For that, as we began, we look at who is the recipient of the income. In our case, it is the foreign company, which is, as we said, a resident of USA. Then we look at that, then we check whether or not there is a DTAA. We did this. Then we will need to look at the MLI to see if whether the treaty has been amended by the MLI. After that, we need to check whether or not the DTAA is applicable. So typically Article 1 and Article 3, 4 of the treaty are known as the gateway to the treaty. And these articles provide as to whom does the treaty apply to. In most of the cases, you will see that you will find language which says that the treaty applies if the person is a resident of one or both of the contracting states. Right. So you need to check whether those conditions are met. If those conditions are met, then you need to examine what is the nature of payment which you are looking at. Now, let us say if we are dealing with fees for technical services, then you would examine whether that kind of a payment is covered under the tax treaty. We know that generally Article 12 or the equivalent, so it is Article 12 of the Model Convention of the UN Model Convention, which deals with fees for technical services and royalties. So you would look at that particular article in the treaty, and let us say if for fees for technical services, the treaty rate is 10%. So now the rate which is specified in Part 2 of First Schedule of Finance Act is 20%, as increased by surcharge and cess, or the rates which is specified in the DTAA, which would be 10% in our example. Whichever is beneficial needs to be applied. We will also look at some of the other slides which talk about some of the documents which are required as far as treaty applicability is concerned. But do remember this is a very important step. Please do not mechanically open the treaty and simply read the rate which is there. Always check whether or not you have a tax residency certificate. Check whether or not we need to have a Form 10F which needs to be kept on record. Determine the eligibility of the treaty. Read the applicable provisions. There are many anti-abuse provisions which are present in a treaty, which prohibit applicability of the DTAA in certain scenarios. And if you satisfy all those things, then you can go ahead and apply the lower rate, which is specified in the DTAA. Another practical aspect is Rule 26. So remember that when we are dealing with payments to non-residents, obviously the payments would be in foreign currency. So the question is, how do you compute the TDS? So Rule 26 provides that we need to take the SBI telegraphic transfer buying rate on the date on which the tax is required to be deducted at source. So let us say if you are booking the invoice on the 14th of May, then you need to check the SBI telegraphic transfer rate, and you need to convert the INR amounts, the foreign currency amounts into INR, and then apply the TDS rate. An interesting question which came up was, would TDS apply in case of exchange rate fluctuations between the date of TDS credit to the payee's account and the remittance date? So let us say the dollar conversion rate of today is 85, and you are making a payment for $100 invoice. So 8,500 is the gross amount of invoice. And let us assume that the TDS rate as per the DTAA is 10%. Now the question is, you have booked the invoice, you have deducted the TDS, you also make payment of the TDS. After 30 days, which is sort of, let us say, the time limit within which you need to make the payment of the invoice, the dollar has strengthened, and the new rate is 86, which means to remit $100, you will need to make a payment of 8,600 instead of 8,500, of course, after accounting for the TDS. And the question was on the differential 100, are you again required to deduct the TDS? And obviously the answer was no. We have a Pune tribunal decision in the case of Sandvik Asia Limited. There is one more provision which one needs to take into account, and this is 206AA. Frankly, the importance of or the relevance of 206AA has gone down post 1st April 2023, and I will explain to you the reason why. First, let us understand what is 206AA. So 206AA is a provision which says that if the recipient, so essentially the non-resident payee does not have a PAN, then you need to deduct TDS at the higher of the rates. And what is the higher of the rates? It is the rate specified in the relevant provision of the Act or the rates in force, or at the rate of 20%. Now, as we would see is, at least as far as dividend payments are concerned, fees for technical services, royalties, interest, the domestic tax rate presently is already at 20%. Okay. Now, when the Section 206AA was introduced, at that point in time, the rates which were in force or which were there in Part 2 of the first schedule, they were actually at 10%. It was only after 1st April 2023 that the rates were increased for 10% to 20%. So at that point in time, this was a significant barrier or a significant provision which always had to be complied with. We still need to check for the applicability of it, but in a sense, the rigors of the section has been reduced because the rate which is present under the domestic tax law itself is at 20%, and then you need to apply the surcharge and cess on those rates, and hence that rate will always be higher than the 206AA rate of 20%. Of course, the question which one may then ask is, let us say you are applying treaty benefits. And under the treaty, the rate is 10%, and you are making payment to a non-resident who has not furnished the PAN, then would provisions of Section 206 AA override? And clearly, the answer is no. Beneficial DTAA provisions will override Section 206 AA. So 206 AA will not apply when you are applying the beneficial provisions of the DTAA, and the lower rate as per 10%, 15%, which is there under 206 AA, will continue to apply. Also, a point to note here is the rate under 206 AA should not be increased by surcharge or cess. There is also Rule 37 BC. Again, this was of real relevance before 1st April 23, which provided for a relaxation. And the relaxation was if the payments to the non-resident was for interest, royalties, FTS, dividends, capital gains, pretty much covers the entire universe. And if you were able to obtain certain information from this particular non-resident, so you know his name, email ID, contact number, address, copy of his TRC, and the tax ID number. Most of these things are usually very easily available. In those cases, the Rule 37 BC said that 206 AA provisions would not apply. Fair amount of litigation in the past, but as I said, not much of application in the present scenario, at least as far as payments to non-residents are concerned. So this is the entire, lay of section 195(1). Okay. Now we will quickly take stock of the provisions of 195(2) and 3 before we move on to some of the more practical aspects of Form 15 CACB. So 195(2) essentially provides is a mechanism where you can apply for a lower or a nil withholding tax certificate. Under section 195(2), the application needs to be made by the payer if the whole sum payable to the non-resident is not chargeable to tax. So you're making a payment of a composite sum and you believe that the whole sum is not chargeable to tax, then you can make an application. There are forms and rules which are prescribed. The slides will be available to you. So, you know, you can take a look at the forms and the rules. The Form 15E needs to be filed electronically through traces along with the supporting documents. But in practice, after filing the form, you still need to submit the physical application along with all the documents with the TDS officer to obtain the certificate. Contrast this with section 195(3). Now, section 195(3) originally was essentially for banking companies and insurance companies. So essentially here an application is made by the payee. So the application is not by the person making the payment, but it is the application is made by the recipient of the income, and it is for receiving interest or any other sum without deduction of tax. So let us say you are dealing with branches of foreign banks. Okay. Remember, if you're dealing with Indian banks, if you would recollect, whenever, you know, we would have so many of our clients who have borrowed money from banks, but we never end up deducting TDS of the bank, right? And that's because it's sort of an administrative hassle then for the bank to ensure if all the customers have correctly paid the TDS to the government. And similar problems are faced by branches of banks, foreign banks or insurers. And so this is the mechanism wherein they can apply for a lower or a nil withholding tax certificate. There is one more section which is applicable, and which is section 197, which you would have heard of. And this is more practically applied, most practically applied in the case of property, immovable property transactions. Of course, you could also look at 195(2). So either 195(2) if the application is made by a payer, or 197 if the application is made by a payee. There are different forms which are applicable, and there are rules which are applicable. There are also certain provisions in terms of when an appeal can or cannot be filed. Please do remember that TDS is only a provisional assessment in that sense. Ultimately, the non-resident person would still need to file their tax return. If there is excess withholding, they can obviously claim a refund by filing it. There is another important concept, and it is the concept of grossing up, which we come across in our day-to-day practice as far as payments to non-residents are concerned. And we also find reference to this concept in Section 195A, although Section 195A essentially talks about grossing up for tax purposes, but it's a commercial concept. So what is the concept? So let us say you are a non-resident company and you are providing services to a company in India, then usually the non-resident companies do not like the fact that the payments which they would receive would be after deduction of taxes. And more often than not, depending on who has the bargaining power in terms of the contract, they would insert a gross up clause which they would say that if there are any local taxes, then those payments need to be grossed up, and they will continue to receive the 100. So remember that whenever you are grossing up, so we have an example on the screen. Let us say the treaty rate is 10%, and we have received an invoice of 100. So we will gross up for taxes. So the grossed up amount would be 111.11, and the TDS of 10% on it would be 11.11, which needs to be deposited with the government. Similar concept as far as 206 AA is also concerned. There is one more important provision which one needs to be mindful about, and this is Section 239A. Now, imagine a scenario where you have made a payment to a non-resident, and because of the gross up situation, you are bearing the taxes. Okay. Now, at the time of making the payment, let us say some documents about the treaty eligibility. Typically, they are tax residency certificate, Form 50 or Form 10F was not made available. However, there is a business urgency or requirement to make the payment. So you gross up the payment, you deduct under the domestic tax law at 20% plus surcharge plus cess. And after doing this, the payee provides you with the necessary documentation, which establishes that they are indeed eligible to claim treaty benefits. And let us say the treaty rate is 10%. Now, given that the taxes have been grossed up contractually, if you had access to these documents before making the payment, then obviously you would have suffered a lower tax. Correct. So here is a mechanism where the tax is borne by the payer, and for whatever reason, either because of a mistake or because there was lack of clarity, or documents were not available, you have sort of deducted tax at a higher rate, and now you wish to apply a lower rate of tax. You can file an application with the income tax office saying that here are the documents and we would like to claim a refund of the differential, because if any excess tax is paid, it needs to come back. Remember, under our constitution, no tax can be collected or levied without the authority of law. So it is, in consequence of this principle that this provision is there. Some practical aspects, the TDS return filing for payments to non-residents needs to be done in Form 27Q. We have the due dates in front of you. I'm sure you would be more up to date with these due dates rather than me. The date of payment of TDS, very similar to resident payment, 7th of the next month. In the case of March, it is 30th of April. TDS certificates again also need to be furnished. Consequences of non-compliance. One very important consequence of non-compliance for payments which are made to non-residents is it will lead to an 100% disallowance in respect of payments to non-residents on which TDS has not been deducted. So again, a very relevant provision. This shows be very careful in understanding or determining the tax liability under section 195(1). Otherwise, at the time of the tax audit, it might happen that you might have previously allowed for a payment to go without deduction of tax, but your tax auditor may not be comfortable with the position which you may have adopted. And this might lead to reporting in your tax audit report, which will then lead to 100% disallowance. I would like to make a point here. So, till many years ago, this provision was only there for non-residents, and this provision, there was no equivalent provision when there was non-deduction of TDS for payments to residents. Now, what happened in those scenarios, certain taxpayers actually then went to courts to say that this is actually discrimination. And the reason for the discrimination is, let us say you are an Indian company, and let us say if you make payment of, let's say professional fees or technical services to a company which is resident in India, and if you have not deducted TDS, then there was no disallowance, in those scenarios. Okay. However, if the payment was made to a non-resident, you are suffering a disallowance. So essentially, there was a discrimination. If you now look at DTAAs, DTAAs have the equivalent of, under the OECD model, we have something called Article 24, which deals with the non-discrimination clause. And this non-discrimination clause of the tax treaty essentially provides that you cannot discriminate between a non-resident and your resident in certain situations. It's a fairly complicated provision, but suffice to know that in the past, when there was no disallowance for payments to residents on account of non-deduction to tax, taxpayers have gone to court. So in fact, we have a decision of the Delhi Tribunal in the case of Herbalife International India Private Limited, where a payment was made to a company, I believe, which was in the US, and under the DTAA, there was a non-discrimination clause, and the disallowance was set aside on the grounds of non-discrimination being there under the DTAA. Of course, this point now is of less relevance, because now, even when you make payments to residents, there is a disallowance. Of course, the disallowance is restricted to a 30% rate, so it's a different point. We have the concept of an assessee in default if you don't deduct TDS. If you deduct and there is a delay, there is interest. Two provisions which I believe all of us as CA final students and chartered accountants need to be careful about is 271I and 271J. So failure to furnish information under section 195(6). And what is this failure? It is the failure as per, so 195(6) essentially talks about furnishing of form 15CB CA, right? And we'll take a look at it. But if there is a failure to furnish, then there is a penalty of up to 100,000, so 1 lakh rupees, which can be levied on the company for non-issuance or non-filing of this form as required by section 195(6). The next one is 271J. So if a CA has furnished an incorrect information in the certificates, let us say that the form 15CB practically asks you, have you received the TRC, when you're granting treaty benefits? Let us say you tick yes, even though you have not received it, and the tax administration uncovers it, there is a penalty. There are many assertions which you are making in the form 15CB, and if these are incorrect, or you have not obtained a management representation letter, you have not obtained sufficient documentation which establishes the basis for the certificate, or you have furnished an incorrect information, the tax department can levy penalty. So please be very careful whenever you are assisting or issuing form 15CB. Now we come to section 195(6). So section 195(6) read with Rule 37BB is the one which says that for every payment which is made to a non-resident, one needs to file a Form 15 CACB as which is applicable, and there are certain exceptions. What I've tried to do here is I've tried to tabulate and let us work through this flow chart. So our starting point will be whether the payment to the non-resident is taxable. Let us say that the payment is indeed taxable and we answer yes. In that case, the next question we need to answer is whether the aggregate payment during the year is up to 5 lakh rupees. If the aggregate payment is up to 5 lakh rupees, you simply need to file only Part A of Form 15CA. You do not require Form 15CB, although in practice, bankers usually always insist on Form 15CB. However, if the payment in the aggregate during the financial year is going to exceed 5 lakh rupees, the next thing which you need to check is whether there is a certificate under 197 or there is an order from the AO under 195, 2 or 3. Have you applied for a lower deduction or a nil deduction certificate? If yes, you need to file Part B of Form 15CA. If no, then we come to, so there is no certificate, there is no lower deduction, the payment is taxable and the amounts are going to exceed 5 lakh rupees in the aggregate, then you first need to file a Form 15CB certificate. Practically how it works is you need to assign the form to your chartered accountant by going into the taxpayer's login. After that, you need to log in into the chartered accountant's portal using his membership number, and then you are able to prepare the Form 15CB. After issuance of the Form 15CB, you again need to ask your client to log into their own portal, and they will be able to then generate Part C of Form 15CA by using the acknowledgement number of the filed Form 15CB. However, there are certain exceptions where a Form 15CB is not required, and that is in case if the remittance is by individuals under the LRS scheme. So, essentially non-business related remittances, travel expenses and the likes, we will look at the list. And, there are exceptions for 33 types of payments. Essentially Rule 37BB has the list of 33 payments. So let us say if you are making payments for import of goods, 15CB is not required. You're making payments for travel, flight tickets, for gifts, donations, etc. Please remember there is an exception in the rules. Many a times the AD banker is not aware about this. They try to insist that please issue the Form 15CB, but always first look at the rules and then only issue it, because if you're covered by the exception, you don't need to issue the Form 15CB. And here is a small summary of which, because Form 15CA is divided into 4 parts, Part A, Part B, Part C, and Part D. So only Part C is applicable as far as Form 15CB is required. So be mindful, be very careful in terms of which Form 15CA part is applicable before submitting it. Luckily now, there's also provision to withdraw both 15CB and 15CA within 7 days of submission. So let us say you submitted it and you uncover a mistake. You are able to withdraw it within 7 days. Remember that if you issue a Form 15CB, you need to generate the UDIN and you also need to update the UDIN against the Form 15CB. So please be mindful about this. In conclusion, this is a bit of summary of what we have discussed today. Understand the nature of the transaction. Understand who is the payee, who is the recipient of the income, his name, legal status, do they have a PAN, do they have a foreign tax identification number, whether or not India has a DTAA, determine the taxability based on the domestic law, then check the DTAA, check whether or not there is an MLI. If you're going to be applying the DTAA, ensure that the beneficial ownership, the LOB clauses, the principal purpose test, all of these are anti-abuse provisions which are there in the DTAA. Those are satisfied. Ensure you have a TRC on record. Ensure that Form 10F is submitted. Form 10F now compulsorily needs to be submitted electronically. Obtain a no-P declaration. If you're chartered accountants or if you're assisting with your seniors, ensure you have an engagement letter in place and an MRL where you're relying on significant declarations before issuance of the certificate, right? To avail treaty benefits, uh, uh, in practice, it is always recommended that TRC should be on record, while there are certain jurisprudence and case laws that mere non-furnishing of TRC cannot deny treaty benefits. Let us say if a TRC is not issued by the foreign country, they would have some other equivalent document which establish their eligibility to claim the treaty benefit, right? Form 15CB specifically asks this question. Please do not make a wrong declaration or a submission. Form 10F compulsorily needs to be submitted and filed online. Now there is a provision wherein non-resident persons are able to register on the income tax portal even without PAN. Okay. However, there are a lot of practical challenges because this requires OTP to go on their mobile numbers and email IDs. And for many of the countries, the OTPs simply do not go. However, it is mandatory for the Form 10F to be submitted online. Remember, Form 10F is only mandatory if all the information like the name, legal status, nationality, address, and the tax identification number and the residency period are not mentioned in the TRC. If all these requirements are mentioned in the TRC, then Form 10F is not required. Although in practice, it is always helpful to insist on it. Last few points of discussion, and I'm conscious that we are close to our wrap-up time. Question is payments to NRO accounts. If you're making payments to an NRO accounts, if you're making payments by credit cards, again, the moot point is if it is a non-resident, you are covered within the scope of section 195(1). You go to 195(6), you look at the rules. If you are covered by the exception in the rules, gifts, etc., there are certain exceptions are there. Then it's not required. Otherwise, compliance with Form 15C BCA is required, even though the banker may not ask for it. In practice, you always face a problem. So let us say if you're issuing certificates in January, February, March, the latest TRC, because in most of the foreign countries, the TRCs are available on a calendar year basis. The latest TRC may not be available, in which case typically you would want to obtain a declaration that they have made an application. The proof of submitting the application is on record and the previous period TRC is on record, and then based on sufficient management representation letters, you may proceed to issue a Form 15CB and grant treaty benefits. We have seen instances when the TRC is not in English, you need to have a duly certified English translation. Please do not use Google. Business registration certificates are issued by some countries instead of TRC. Important question could be if you're making payments for reimbursement, whether Form 15CB is required or not. Again, a very tricky question, but remember 195(1) makes it clear that it applies if the sum is chargeable to tax. So you will clearly need to be able to answer the question. If the sum is chargeable to tax, then yes, you will need to do the withholding. However, if the sum is not chargeable to tax, then on reimbursements, you may be able to take a view that there should not be any withholding applied. You have a plethora of decisions here because it could be instances where it's simply cost sharing, which is being reimbursed, or it could be back-to-back reimbursements. However, in a majority of the cases, what we see is there is lack of sufficient documentation to establish that it is a pure reimbursement. Many a times there is a markup or a margin which is added by the foreign company in the guise of reimbursement, in which case please be very careful because of the onerous provisions of Section 195 and the chances then that the entire payment may be disallowed at the time of audit. Payment for import of goods clearly covered by the exception, so you don't need to file 15 CACP. With this, I believe I would like to wrap up my presentation. Sorry if it felt slightly rushed towards the end, but I tried to cover what was possible given the time. I am happy, to check with the organizers if there are any questions which the participants may have. Then I'm happy to answer those.
Hello. Yes, sir. Before we move forward, we have a few questions in our Q&A box.
Sure, Madhur. Do you mind, taking one by one, and I'll
Yes,
be happy to answer them.
yes, sir. So, first question we have is, where is it specified that surcharge and cess is not applicable on DTAA rates?
Okay. So you will not find it specified anywhere, but the way it is interpreted, of course, there are certain case laws on it. But the way it is interpreted is if you look at the DTAA, a DTAA typically would provide that the source country may levy tax at a rate not exceeding 10%, 15%, 20%. Right. So it simply says that tax may be levied not exceeding a particular rate. Now, when we look at Section 90, Section 90 makes it very clear that the provisions of the Act or the DTAA, whichever are beneficial, apply. Okay, and DTAA provisions are very clear that they provide for a rate of 10%, 15%, etc. So it is a settled position in law that surcharge or cess should not be applied on DTAA rates, and there are case laws also, including ones which are included in my presentation, which I'll circulate tomorrow. So you can take a look at that.
Okay. Moving forward, if a non-resident has a business connection in India but no permanent establishment as per DTAA, is TDS still deductible under Section 195? And what is treatment under Article 7 for business profits?
So, a very nice question again. So, when we are talking about payments which are in the nature of business payments, and we are talking about other than fees for technical services. As you correctly said, we need to look at Section 9. And Section 9, we find the concept of business connection. Now, business connection is not defined per se in Section 9, but the term has been very widely been used. Okay. So it is quite possible that the non-resident person has a business connection in India, bringing the particular payment within the tax net. Now, let us say this person is coming from a country with which India has a DTAA in place, right? And when we examine this DTAA, provided it is applicable, what you would see is we have equivalent of Article 7. And Article 7 says that business income of a non-resident person is only taxable provided the person is carrying on business through a permanent establishment in the source country. Okay, so what does it say is that the foreign company needs to carry on business activities through a permanent establishment in India. Okay, and then permanent establishment is a term which is again defined in Article 5. So what you would then need to do is you would then need to go to Article 5 of the DTAA. You would need to check the clauses. If your conclusion is that the non-resident or the foreign company does not have a permanent establishment in India, Let us say it does not have any agent in India, it does not have an office in India. Let us say the employees of the foreign company are not physically visiting in India. They are providing the services by being outside India, and you are able to arrive at that conclusion. Then Article 7 would say then the profits of such a foreign company are only taxable in the country of its residence, which would be USA, France, UK, whichever country it is coming from, and not in India. And these beneficial provisions of the DTAA would then override the provisions of the domestic tax law. So that is the chain of analysis which one needs to do.
Okay. Moving forward, if higher rate of TDS is mistakenly deducted due to non-application of DTAA, how can the non-resident claim a refund? Can the Indian pay apply for rectification, or is refund route only via return filing?
So in practice, the refund route is via return filing. And what we also see is many a times what happens is on a conservative basis, the Indian company would want to deduct TDS as per the domestic tax rate, right? So 20% plus surcharge less, because they do not want an inquiry from the income tax office. They do not want to take on that risk. In such a scenario, you can actually advise the non-resident company that, we can assist you with filing of the tax return and claiming the refund, because let us say if the DTAA rate is 10%, you will be entitled to the refund of the balance 10%, subject to going through the rigors of assessment, but something in practice which is often adopted.
How does TDS apply when payments are made to branch of non-resident versus a wholly owned subsidiary abroad?
So how does TDS apply
when payments are made to branch of a non-resident versus a wholly owned subsidiary abroad?
Okay, so if the payment is made to a wholly owned subsidiary abroad, then obviously it's a non-resident person, and Section 195 would apply. I think with branch there are certain decisions. So let us say, the question which is thought to be asked is, let us say I have an Indian company, and let us say if the Indian company has a branch outside India, and let us say you are making a payment to that particular branch. I think there are certain decisions which have said that you cannot, TDS should not apply, because the branch and the Indian company are one single person, and no income gets generated because of this payment. So TDS in those scenarios should not apply.
So one of our attendees have came up with a case study, and it is
Okay.
one of our client has deducted TDS on purchase of immovable property from NRI at 12.5% plus surcharge of 15% plus cess. But the IT department has still raised additional demand and surcharge is 25%. So is this correct, or we can appeal against this?
So I would not want to comment on client specific situations, but broadly the way it works is, as far as capital gains is concerned, uh, as far as sale of immovable property is concerned, for long-term capital gains, after the July 2024 amendment, the basic tax rate is 12.5% plus applicable surcharge and cess. Now it looks like there is a dispute in terms of the rate of surcharge which has been applied at the time of deducting and filing the TDS return compared with the rate of surcharge which has been which the income tax department is alleging. Now the rate of surcharge as far as individuals, for non-resident individuals, is a fairly it's a fairly settled position. So one needs to simply look at what is the correct rate of surcharge, and whatever is the correct rate will always apply. So I think so. So I think there's a bit of disconnect in the question. So it's more around what the surcharge rate should be, and of course one needs to examine depending on the threshold, because the surcharge rates are different depending on if the payment exceeds 50 lakh rupees, 1 crore rupees, 5 crore rupees, etc. It's a graded surcharge rate.
Okay. Sir, as the queue for questions is constantly increasing, I would limit it to last two questions.
Sure.
And suppose a Singapore company sells shares of an Indian company to non-residents, how is TDS determined under Section 195?
Okay. So Very good question again. So you have a Singapore company which is selling shares of an Indian company, and the sale is also happening. The buyer is also a non-resident, right? So basically, you have a non-resident buyer, you have a non-resident seller, but the asset is shares of an Indian company. Now the question is, does 195(1) apply? No. So the first question is, who is the recipient of income? The recipient of income is obviously the Singapore company, which is the seller of the shares. Is this income subject to charge to tax in India? We will look at 9(1). Clearly under 9(1), if the asset is located in India, it is within the charging provisions. Then we need to go to look at 195. And under 195, any person making payment to a non-resident in respect of any sum chargeable to tax in India is covered, right? So even though a non-resident is making payment to another non-resident, because the income is chargeable to tax, 195 is covered. Then you would need to look at what is the applicable tax rate under domestic law, whether it is short term, whether it is long term. Then you would need to examine the India-Singapore Treaty, correct? So India-Singapore Treaty, again, whether the treaty is applicable, it is not applicable. You would need to look at Article 13. You would need to look at the position of when the original shares were acquired, because there were some amendments which were brought in which dealt with the taxability. So I believe as long as you follow the steps, the answer should be available. But if the question is, does 195 apply? It definitely applies. Should Form 15C be issued? It definitely should be issued, even though the AD bank will not ask for it, right? Because the payment is simply going to go from one non-resident's bank account. Let us say the buyer is located in France and the seller is the Singapore company. Nobody is going to ask you for a 15CB, but you still need to comply for it because the law requires you to do that.
Okay. So last question.
Sure.
Is 15CB applicable in case of capital gains on transfer of shares of an Indian company to another company? And if yes, what is the rate of TDS to be deducted?
I think a very similar question to the one I
Yes,
just
just answer.
answered. I think there's no point in commenting about rates because please remember, every scenario is unique. Always do your analysis. I mean, if you're talking about capital gains on transfer of shares, is it a long-term asset? Is it a short-term asset? Under the domestic law, you always need to increase it by surcharge cess. Then you check which is the treaty. If the treaty is applicable, you go to Article 13 equivalent. Under the Article 13 equivalent, does India have a right to tax? If yes, you apply the rate as per the domestic tax law. If no, then there is no withholding. So I cannot tell you what is the TDS rate, but yeah.
Right. So moving forward, I would request all the participants. Thank you for all your questions, but we cannot take further questions. And taking this session towards a formal vote of thanks. Before
Sure.
that, so we have received many requests for the PPT of today's session.
So definitely,
So
I will share with you. I'll share with you right after the session. I mean, the PPT is ready, so
sure, sir.
I'll
Sure,
share.
sure,
So you
sure.
can circulate it to all our participants. And if any
Great,
of them have
great.
any questions, I'll be happy to answer it. My email is there. More than happy. So no client-specific questions, but any general questions about the law, I'm more than
Absolutely.
happy to answer in terms of what the process should.
Absolutely. Taking this session towards a formal vote of thanks, uh, I I would now request, uh, sir, may I?
Sure.
Yeah. So, first and foremost, I would like to express my deepest gratitude towards visionary leaders of WIRC. Thank you, CA Ketan Sayya, Chairman of WIRC, for constant encouragement and for championing efforts that empowers the entire generation of chartered accountants. A heartfelt thanks to CA Piyush Chandak, Vice Chairman of WIRC, whose unwavering support has been instrumental in making today's program a huge success. A grateful thank. We are equally grateful to CA Jinal Savla ma'am, the Secretary of WIRC, and CA Fenil Shah, Treasurer of WIRC, for their valuable contribution to the students' fraternity. A special thanks to WRC regional committee members for for being guiding force and for their student-centric events. We are immensely thankful to CA Jitendra Saglani, Chairman of Vikasa, for his consistent support, vision, and dedication towards student development. Your leadership truly makes a difference, sir. Now, to star of the day, our speaker, CA Siddharth Parekh, sir. Your brilliant and deeply informative session on TDS, TCS for non-residents and DTAA has been very insightful. Your ability to simplify complex tax concepts and present them with such a clarity is truly commendable. With your rich experience as a speaker, educator, and active contributor to the tax and finance community, today's session reflected not just your expertise but also your passion for empowering students. We are grateful to your to the practical insights you have shared and valuable knowledge we have to carry forward. A huge shout out to all the coordinators and team members who work tirelessly behind the scenes to make this event seamless. And of course, to our audience, thank you for your enthusiasm, attention, and active participation. Events like this become meaningful because of your involvement. Thank you once again and wishing you a very all the best for the journey ahead.
Thank you. Thank you so much.
Thank you so much, sir, for your time.
No, no, thank you so much for having me here. It was a pleasure, and thank you to all the participants for being active. And I hope everybody found it useful. Thank you.
Sir, we